All right, let's get right into it. At the start of 2025, there were these massive questions hanging over the market. Well, the year's about wrapped, so it's time to hand out the grades. We're giving 2025 its final report card, and I'm going to reveal the one single number that's going to define everything next year.
So you got to ask, right? How did the year really stack up against what we all expected? We're going to look at count them, four critical areas that really shaped the entire investing landscape this year. We're talking everything from interest rates to the job market. Think of this as the final exam for 2025.
So here's the game plan. First up, we're going to tackle interest rates, specifically that all-important 10-year Treasury. Then we'll dive into the labor market and see how it held up. After that, we'll cut through all the political noise from Washington and see what actually mattered to Wall Street. And finally, we'll hit the big one, the single most important driver for stocks, corporate earning. Okay, first question on the test. This one was all about interest rates. And when we talk interest rates, we're really talking about the 10-year Treasury. I know, it sounds a little technical, but trust me, its direction dictates so much, from your mortgage all the way to your portfolio. So at the beginning of the year, here was the big tug of war. The 10-year yield was sitting right around 4.5%. The question was simple, but the stakes were huge. Was it going to fall to 4%, which would be great news, right? Cheaper money for everyone to grow? Or was it going to spike to 5% and slam the brakes on the whole party?
Well, we got our answer, and it was a clear one. The yield hit 4% first. No question about it. And let me tell you, that was a huge win for the bulls.
Just take a look at how this all unfolded. It hit a low point back in the spring, but the real story, the key moment, was later in the year. See, as the Fed started cutting rates, the 10-year just kept knocking on the door of that 4% level. Bam, bam, bam. Pretty much locking in that downward trend for good.
So, where are we now? Well, it's hovering right around 4.15%. Look, would we have loved for it to stay under 4? Of course. But let's be real, this is still a really healthy spot to be in. It's a level that absolutely supports growth in the stock market.
And this is the bottom line. Don't let anyone freak you out about this. A yield around here, it's fine. It's totally fine for stocks. It's that sweet spot where things aren't too hot, not too cold. It's just right.
Okay, so question 1 gets a passing grade. Interest rates played nice, which was great news. But what about the engine of the whole U.S. economy? I'm talking about the labor market. The story coming into 2025 was all about how red hot and tight it was. But the big question was, could it last?
So, did that tight labor market continue? The answer was a big, fat no.
I mean, just look at these numbers. They tell the whole story. We went from adding over 100,000 jobs a month in the beginning of the year to an average of just 17,000 in the back half of the year. Honestly, that's kind of pathetic. We even had some months where we actually lost jobs. And here's what that did to the unemployment rate. It ticked up from 4% all the way to 4.6%. Yeah, that is definitely not what a strong labor market looks like. But here's the funny thing, the big twist in the story. For investors, this weakness was actually good news. Why? Because a cooling job market takes the pressure off inflation, and that gave the Fed the exact excuse it needed, the green light, to step in and start cutting interest rates. So bad news was actually good news.
All right, let's move on. Question number 3. Yes, the never-ending drama between Washington, D.C. and Wall Street. The big question on everyone's mind was, how would the Trump administration really affect our portfolios?
Well, you know what? Forget the headlines for a second and just look at the numbers. They tell the real story. The NASDAQ, up over 21%. The S&P and the Dow, strong double-digit gains. The bottom line here is simple. All that political drama was just noise.
And the market did this while facing some serious headwinds. I mean, do you remember that massive 21% scare we had over tariff fears? The market just shook it off and bounced right back. It even survived the longest government shutdown in U.S. history. We're talking 43 days. And it just snapped right back like nothing happened.
And this quote just nails it. Look, there's always going to be some political drama, some controversy brewing in Washington, but when you get right down to it, Wall Street really only cares about 2 things, earnings and the economy. All the other stuff, I guarantee you, they couldn't care less. Which brings us perfectly to our 4th and final question. The one thing Wall Street absolutely cares about, earnings. Because at the end of the day, profits, that's what moves stocks. It's that simple. So what was the verdict on earnings growth this year? Okay, now pay close attention because this is really the key to everything. At the start of the year, everyone was expecting 12% earnings growth. We're going to come in a little shy of that, maybe around 10%. A little disappointing, right? But, and this is a huge but, look at the forecast for next year. For 2026, that number has actually jumped up to almost 14%.
And that right there, that leads us to the single biggest takeaway from this whole report card. All of this, the interest rates, the jobs, the politics, it all boils down to one critical number moving forward. 14%. That's it. That's the number. If you remember one thing, remember that number. It is, without a doubt, the most important figure for the market as we head into 2026. Pretty much everything is riding on it.
So let's put it all together. The outlook for future earnings has actually gotten better this year. But that optimism comes with a catch. It sets a really, really high bar. For this market to keep rolling, to keep charging ahead in 2026, we have to hit that 14% earnings growth. It's not a nice to have, it's a must have.
And so that's the million-dollar question for 2026, isn't it? We know the job market is getting weaker, and that could mean people spend less. So with that as a backdrop, can American companies really deliver the kind of explosive 14% growth Wall Street is now banking on? That, my friends, is the story we'll all be watching next year.